Your market news now. Global stocks are down for a third straight day after Federal Reserve meeting minutes bolstered bets on another U.S. rate hike this month. The latest flare-up of tensions between the U.S., Europe and China have also hit market sentiment. Stateside, Meta bucked the slide in rate-sensitive technology and growth companies as it launched a Twitter-like app called Threads after a dismal 2022. Big growth in technology stocks such as Meta have since seen rather outsized gains this year, with the Nasdaq clocking its biggest first-half rise in 40 years. Investors are focused on U.S. jobless claims, the JOLTS, as well as private payrolls data that's due later in the day, as well as the Institute for Supply Management's non-manufacturing PMI numbers. To talk to us a little bit more about what is happening in the markets, we are joined by Patrick Martini, who is the head of trading at Aluwani Capital. Patrick, thank you so much for your time. Your initial reaction and takeaway as you look through those FOMC minutes.
Yeah, good afternoon, Anastasia, and thanks for having me. Essentially, the Fed and other central bankers across the world, have been warning around inflation being a lot more stickier than anticipated. So the minutes that came out for the June meeting actually confirmed that. So even though they paused at that meeting and did not hike, which left the market thinking that perhaps the Fed has reached its peak in terms of rate hikes, the minutes that came out actually reconfirmed that we're not off the hook yet. The risks are definitely to the upside in terms of there being more rate hikes, especially to the extent that the inflation numbers out of the U.S. remain elevated.
Is there a risk of a policy error when you look at all of these central banks? Because essentially you get the sense that they are battling a trilemma here, fighting inflation, having not to, kill growth, but yet at the same time balance financial stability.
Yeah, I think it's an interesting question in the sense that if you look at how we got here, the accelerated rate hikes that we've seen over the last sort of 12 to 18 months have been on the back of the initial diagnosis of inflation, which was misplaced. So you may think back to about 2 years ago, the whole transitory form of inflation, largely on the back of COVID, the supply chain blockages. Those inflationary pressures proved not to be transitory. In fact, proved to be a lot more stickier with other parts of the global economy actually experiencing high inflation. Clearly, the war in Ukraine did not help. It just made matters worse, and which then prompted some bankers to actually hike quite aggressively. So yes, there is therefore that risk that perhaps they're overdone, and especially when you look at other parts of the economy where there may be signs of a recession coming through. However, at an average level, and if you strip out certain components of inflation, it is clear that the impact of rate hike is yet to be felt as we remain with very high inflation still. So the risk of therefore a policy error, as in hiking too much, the point where you tilt the economy into a recession, I think that is real, which is why if you look at the bond market, that market has been pricing in a recession, a mild one to say, but still a recessionary environments for the latter part of this year.
We've just kicked off the first week of the, call it, second half of the year. When you look back at the first half and what it's delivered, what were the surprises for you?
I think the big surprise is the extent to which China has disappointed, and it continues to disappoint. So Q4 last year, they announced the reopening after sort of enforced closures on the back of COVID. So there was a lot of optimism that with that reopening, commodities and the trade across the globe would improve. Unfortunately, 6 months down the line, if you look at the savings number that came out a few days ago, all major key economic variables coming out of the Chinese economy point towards that economy being, in the doldrums, to the extent that there is an expectation of some stimulus, at least in the second half of this year. So the extent to which China is disappointed was a big surprise. But I guess, on the other front, if you look at South Africa specifically, and we've seen a lot of this also in other parts of the world, we continue to experience, these macro events that have got nothing to do with the fundamentals of the market, but somehow still impact, the global economy, the global financial economy. Initially, it was the U.S. Banking crisis, and then obviously we had our own issues in May, when it came to geopolitical pressures. So geopolitical pressures appear to be with us. I think it's a question of what's next, where it's going to come through from. But certainly, there are a lot more risks coming through from the left field, which have nothing to do with financial markets.
On that note, then, how do you think about, slowdowns in the second half of the year? Do you buy the dip?
You have to remain invested. I think the market is offering a lot of value. There's a lot of uncertainty, yes. There's a lot of negativity, but a lot of that is already priced into major parts of the market. So you have to be selective. There are good opportunities out there, and just continue to be invested. The last thing we want to do at this point in time is to sit into cash, because with inflation coming down and hopefully we start to get rate cuts coming through, cash won't do much for you. Especially when you look at it against inflation over the long term. So indeed, we are buying the dips. We are very selective though. So we're not buying across the board, but we do think that the market does offer unique opportunities at this point in time.
Patrick, thank you so much for your time. That is Patrick Martini, who's the head of trading at Aluwane Capital.